Hey everyone, welcome back to Corporate Decoder, the place where we dive into the financial secrets of big companies. Today, we are unwrapping the Columbia Credit Income Opportunities Fund's latest report. Get ready because this one is packed with more than just numbers. It is a story about how this fund is playing the market, and for an interval fund, that is especially interesting. Before we jump in, if you appreciate getting straight insights from these corporate documents without the Wall Street jargon, make sure you're subscribed. And hey, if you like chatting about finance and getting access to more exclusive content, join our Discord community. The link is in the description below. So, what exactly is this Columbia Credit Income Opportunities Fund? Think of it as a specialized investment fund that aims to generate income. It is a closed-end fund, which means it is not constantly issuing new shares like your typical mutual fund. And it is an interval fund, which is a bit of a hybrid. It offers shareholders some liquidity by repurchasing shares periodically, but it is not as easy to get your money out as with a regular open-end fund. Let S get right into what they're reinvesting in. As of the 31st of July 2025, a big chunk of their investments, about 53%, is in residential mortgage, backed securities that are non-agency. This means they're rebacked by mortgages but not guaranteed by government entities like Fannie Mae or Freddie Mac. This kind of investment can offer higher returns, but it also comes with more risk, especially if those mortgages go bad. And speaking of risk, this report really emphasizes market risk. They're pretty upfront that turbulence in financial markets, economic downturns, or even global events like natural disasters or health crises can really hurt their investments. This is especially true for their mortgage-backed securities because if housing values drop, people are more likely to default on their loans. Looking deeper into their investments, we see a significant portion, nearly 30% in asset-backed securities that are also non-agency. Think of these as pools of loans like auto loans or credit card debt, packaged up and sold to investors. The report mentions specific examples like Affirm Asset Securitization Trust, Cherry Securitization Trust, and Freed Abs Trust. These are complex instruments, and the report even notes that the actual cash payments received from them are not known until the time of payment, which adds a layer of uncertainty. Going back to those residential mortgage-backed securities non-agency investments, they put a substantial amount of money here. The report lists out many specific holdings. For example, they have investments in things like a AMP Mortgage Trust, Colorado LT Mortgage Loan Trust, and Torac Mortgage Trust. These are structured like collateralized mortgage obligations, or CMOS, which means different parts of the mortgage payments are sliced up and sold to different investors. The specific coupon rates or interest rates on these are quite varied, some going as high as 10 to 12%. This signals they are hunting for higher yields, which, as we know, usually means higher risk. While they are heavily focused on debt-related securities, they do have a small slice, about 2%, in common stocks. Interestingly, all of this is in the financial sector, specifically in mortgage real estate investment trusts, or REITs. They hold stocks in companies like AGNC Investment Corp. and Annaly Capital Management Incorporated. These companies often deal with mortgage-backed securities themselves, so it looks like they're replaying a theme here, both in direct investments and equity holdings. They also hold a small percentage, about 6%, in money market funds. This is likely for liquidity, meaning they have cash readily available to meet short-term needs or to make new investments. They are invested in the Columbia Short-Term Cash Fund, which is an affiliated money market fund. This means it is managed by an affiliate of the fund manager, and this is pretty common in the fund industry. There is a note that these money market funds could be subject to fees if net redemptions exceed certain levels, which is a recent regulatory change to keep these funds stable. Now, let's look at the balance sheet, the consolidated statement of assets and liabilities. As of the 31st of July 2025, the Fund's total assets were around $58 million, with total liabilities of about $68,000. This means the fund has a good buffer. Net assets applicable to outstanding capital stock stand at a healthy $58.12 million. Looking at the shareholder breakdown, Class A shares represent the majority of the net assets, about $55.3 million, with 2.7 million shares outstanding. The net asset value, or NAV per S-share, for Class A shares is $20.36. They also have an institutional class with about $2.8 million in net assets and 138,000 shares outstanding, with a slightly higher NAV per S-share of $20.38. This small difference in NAV between share classes is often due to how expenses are allocated. Let's move on to how the fund actually made and spent money. From the 17th of April 2025, when they started operations, to the 31st of July 2025, the fund reported net investment income of almost $1.6 million. Their income came from dividends and a significant amount of interest, with interest income alone being over $1.7 million. However, expenses are a big part of any fund. Total expenses were around $366,000, but here is an interesting point. The investment manager and its affiliates actually reimbursed over $62,000. This means they voluntarily covered some of the fund S costs, likely to keep the overall expense ratio attractive for investors. This highlights the importance of looking beyond just the reported expenses to see what the manager is actually covering. The report also states future fee waivers are contractually agreed upon through November 2026. On the gains and losses side, the fund had a net realized loss on investments of about $186,000. But they also saw a nice bump in their unrealized appreciation, that's gains on investments they still hold, to the tune of over $510,000. So overall, the fund saw a net increase in its net assets resulting from operations of nearly $1.92 million for the period. The financial highlights table gives us a per share look at performance for class. As shares, the net asset value at the end of the period was $20.36 and the total return was 3.65%. For institutional class shares, the NAV was $20.38 and the total return was 3.88%. These are solid returns for a short period, especially considering the market conditions they likely navigated. The expense ratios here are also important. The net expense ratio for Class A is about 1.99%, and for institutional class it is 1.49%. These appear to be competitive within the industry for this type of fund. Now, diving into the notes to consolidated financial statements gives us more detail. They have a subsidiary, Columbia Credit Income Opportunities Subsidiary Fund, Incorporated LLC, which is a common structure for investment funds to use for certain strategies. The notes also detail their strict accounting policies, especially around security valuation. They use a 3-level hierarchy to determine fair value based on observable inputs. Most of their assets, nearly $53 million worth, fall into level 2, meaning they use observable inputs other than quoted prices. This is typical for the types of securities they hold. The fund also explicitly outlines its risks. Interest rate risk is a big one. They explain that when interest rates rise, the value of their debt instruments tends to fall. And given they hold a lot of mortgage-backed securities, changes in interest rates, economic conditions, and even prepayment speeds can significantly impact their value. They also point out liquidity risk, which is the risk of not being able to sell investments quickly at a fair price, and mortgage and other asset-backed securities risk, which directly relates to the quality of the underlying loans. A really unique and important risk highlighted here is shareholder concentration. At the 31st of July 2025, a massive 87.9% of the outstanding shares were owned by affiliated shareholders. This is a huge concentration, and it means that if these large affiliated shareholders decide to redeem a significant portion of their shares, it could force the fund to sell its investments at inopportune times, potentially at a loss, and could really impact the fund's performance for remaining shareholders. This is a critical point to watch for this fund. Their financial statements have been audited by PricewaterhouseCoopers LLP, who found that the financial statements present fairly, in all material respects, the financial position and results of operations. This gives us confidence in the numbers presented. Interestingly, the report details the Board of Trustees' approval of the management agreement with Columbia Management Investment Advisors, LLC. They discuss the nature of the services, investment performance potential, comparative fees, and economies of scale. It is a thorough process, and it is good to see the board scrutinizing these agreements to ensure they are in the best interest of shareholders. They specifically noted that the proposed total expense ratio after waivers was below the median for similar funds. Looking at who is managing the money, Jason Callan and Ryan Osborne, with their co-portfolio manager roles, are managing billions of dollars across multiple registered investment companies and pooled investment vehicles. While they manage a lot, the report doesn't indicate that their compensation is directly tied to the performance of these specific funds in a way that would create an obvious conflict of interest. However, like many portfolio managers, they do manage accounts with different fee structures which can create potential conflicts that are addressed through compliance policies. Now, for my take on all of this, the Columbia Credit Income Opportunities Fund is clearly navigating a complex financial landscape. Their heavy focus on non-agency mortgage and asset, Backed securities shows a strategy geared towards higher yields, which could be attractive in a low interest rate environment. However, this also exposes them to significant interest rate risk and credit risk. The fact that they have contractual fee waivers through November 2026 is a positive sign for investors, helping to keep immediate costs down, and the management S approval process for the management agreement seems robust. The real standout and frankly a significant concern is the extreme shareholder concentration with affiliated investors. While this might provide stability in normal times, it creates a potent risk if those affiliated investors decide to exit. This could force liquidity events that negatively impact all shareholders. It is a calculated trade, often investors need to be aware of it. Overall, the fund appears to be managed prudently given its strategy with solid financial reporting and oversight. The challenge for them will be managing the inherent risks in their chosen asset classes and navigating the potential impact of large shareholder redemptions. Alright, that is our breakdown of the Columbia Credit Income Opportunities Fund. S latest report, what is your take on these numbers and what they signal for the company S future? Especially that shareholder concentration. What do you think about that? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. And remember, you can join our Discord community linked in the description for more discussions and exclusive content. Thanks for watching. See you next time.